Our planet is currently experiencing significant environmental and social challenges. Climate change, pollution, and social inequality threaten our very existence. Sustainable finance offers a path forward, aligning financial systems with the needs of both people and the planet. Simply put, sustainable finance means investing in a way that considers environmental, social, and governance (ESG) factors. It's about looking beyond short-term profits and embracing a long-term vision. Are we funding renewable energy or fossil fuels? Are we supporting fair labor practices and human rights? Sustainable finance is about creating a future where economic growth goes hand in hand with environmental protection and social well-being. For too long, we have operated under the assumption that economic growth must come at the expense of the environment. This simply isn't true. Sustainable finance recognizes that a healthy economy depends on a healthy planet and a just society. Investing in renewable energy, sustainable agriculture, and clean technologies not only protects our planet, but also creates new jobs and stimulates economic growth. Social well-being is also crucial for economic prosperity. Sustainable finance promotes investments in affordable housing, healthcare, education, and community development. It seeks to create a virtuous cycle where each element reinforces the others, leading to a more sustainable and prosperous future for all. Across the globe, a profound shift is occurring. Investors, companies, and governments are waking up to the importance of sustainability. They are recognizing that environmental and social risks can translate into significant financial risks. Investors are increasingly seeking out companies with strong ESG performance. These companies tend to be more resilient to environmental and social changes, have stronger brand reputations, and attract and retain top talent. Companies are adopting sustainable practices, reducing their environmental footprint, and investing in their workforce and communities. This not only reduces risk but also unlocks new market opportunities and enhances brand value. Governments are implementing policies to promote sustainable finance, such as carbon pricing, renewable energy subsidies, and ESG disclosure requirements. The growing interest in sustainability is reshaping the financial landscape, driving innovation, and fostering a more resilient global economy. At the core of responsible investment are ESG criteria, environmental, social, and governance factors. These principles provide a framework for assessing the sustainability performance of companies and investments. Environmental principles evaluate a company's impact on the natural world, including carbon emissions, energy efficiency, water usage, and waste management. Investors seek companies that are actively reducing their environmental footprint. Social principles focus on a company's relationships with its stakeholders, including labor standards, human rights, diversity and inclusion, and community engagement. Investors aim to support companies that treat their stakeholders fairly and ethically. Governance principles examine a company's leadership, executive pay, shareholder rights, and board diversity. By integrating ESG principles into investment decisions, investors can identify companies that are not only financially sound but also operate in a sustainable and responsible manner. Let's explore the concept and significance of the triple bottom line, which challenges the traditional business model that focuses solely on maximizing profits. Sustainable finance challenges the traditional business model that focuses solely on maximizing profits. It embraces the triple bottom line, which considers people, planet, and profit as interconnected measures of success. Companies embracing the triple bottom line measure their success not only by their financial performance but also by their social and environmental impact. They strive to create value for all stakeholders, not just shareholders. This includes paying fair wages, providing safe working conditions, minimizing environmental impact, and giving back to the community. By taking care of people and the planet, businesses can enhance their long-term profitability and create a more sustainable and equitable future for all. Sustainable finance encompasses a wide range of investment approaches and financial instruments. Green finance focuses specifically on investments that provide environmental benefits, such as renewable energy projects and green buildings. Green bonds are designed to raise capital for projects with positive environmental outcomes. Social finance aims to address social challenges such as poverty, inequality, and lack of access to essential services. This includes investments in affordable housing, healthcare, education, and community development. Social impact bonds fund programs that deliver positive social outcomes, with investors receiving returns based on the program's success. Impact investing seeks to generate measurable, positive social and environmental impact alongside a financial return. Impact investors actively seek out companies and projects tackling pressing global challenges. Climate finance focuses specifically on investments that address climate change, including renewable energy and climate adaptation. These different types of sustainable finance offer diverse investment opportunities for individuals and institutions. They align portfolios with values and contribute to a more sustainable future. Here, we will discuss the numerous benefits of sustainable finance. Beyond the ethical imperative, sustainable finance offers a compelling business case. Risk management. Sustainable finance helps mitigate environmental, social, and governance risks. Companies with strong ESG practices are less likely to face environmental fines, lawsuits, or reputational damage. Long-term value creation. Sustainable finance focuses on long-term value creation rather than short-term profits. Companies with strong ESG performance tend to be more resilient, innovative, and better positioned for long-term growth. Positive societal impact. Sustainable finance channels capital towards projects and companies making a positive difference. By investing in renewable energy, sustainable agriculture, and social enterprises, investors contribute to a healthier planet and a more just society. Alignment with values. Sustainable finance allows investors to align their investments with their values. While sustainable finance is gaining momentum, several challenges persist. Greenwashing. A significant issue is greenwashing, where companies exaggerate or misrepresent their environmental or social credentials. But it goes beyond just misleading claims. Lack of standardization. The absence of standardized definitions and metrics for measuring and reporting ESG performance complicates comparisons between companies and investments. Regulatory barriers, inconsistencies, and a lack of harmonization across jurisdictions can hinder investment. Data availability and quality. Access to reliable and comparable ESG data remains a challenge. Enhancing data availability, quality, and comparability is crucial for enabling investors to make informed decisions. ESG-focused funds. The number of ESG-focused investment funds is rapidly growing, providing investors with a wide range of options. Technological advancements, such as artificial intelligence and blockchain, are playing a crucial role in advancing sustainable finance. These technologies are improving ESG data collection, analysis, and transparency. Growing investor demand. Investor demand for sustainable investments is surging, driven by a growing awareness of environmental and social issues. This increasing demand is driving capital towards sustainable investments, further accelerating the growth of the market. Future trends in sustainable finance are shaping the way we invest and think about the environment. The importance of global collaboration in sustainable finance. Addressing global challenges like climate change and inequality requires a collective effort. Global collaboration is crucial for the success of sustainable finance initiatives and creating a more sustainable future. International cooperation can help harmonize ESG reporting frameworks and mobilize capital for sustainable development projects. By working together, governments, investors, businesses, and civil society organizations can accelerate the transition to a more sustainable and equitable world. The future of our planet depends on our ability to create a financial system that supports both people and the planet. Sustainable finance offers a pathway to a more just, equitable, and sustainable world. It's about recognizing that our economic, social, and environmental systems are interconnected. Let us embrace sustainable finance practices and work together to create a world where both people and nature can thrive for generations to come. T.